Cool. So I'm going to get started. I want to thank everyone for joining for today. So my goal is I have a presentation. I'll go through a number of slides about how to model safes. And then I'll leave some time to go through an example of a spreadsheet and then answer kind of questions. And so my goal is to leave time and space to answer as many questions as possible comes up. I know this stuff gets very specific, so I'll try to leave some space to answer things. The slides and the example kind of model will be available after the class. So you'll get an email after the class, and you'll be able to download the slides and download the spreadsheet that we use in the class as well as recording this if you weren't able to join. So let's get going. So my name is Taylor. I have a BA in economics from University of Virginia, and I did my MBA in finance and accounting from Tepper School of Business at Carnegie Mellon. Neither of which taught me any of this stuff. We all have to learn kind of later. Used to work as a venture capitalist, worked as a EIR venture investor venture investor in residence for Venture for America, ran product and forecasting for e-commerce company, and done a bunch of other things. For the last 5 years, I've run Foresight full time. So Foresight is a boutique product and services company where I focus on financial modeling and forecasting for startups and venture funds. And I always like to frame up everything I give about why I care about financial modeling. And I care about financial modeling because for me, I believe that financial models can help us make valuable, critical business decisions, even if the models themselves are not always right. That's an important thing. People have an expectation or idea that the goal of models is to create something that's right. And that's actually not the point. Like, the goal of models is not the artifact of the model itself. It's the process of creating a model that forces you to think about the actual business. That's the important, valuable part, is not the actual artifact of the model first and foremost. And so if you use it as a tool for critical business decision-making, then it's a valuable tool, even if the actual forecast at the end turns out to not be exactly right, which is going to happen because it's impossible to accurately forecast the futures of immature business and things in the future. So I always like to frame up the idea behind that. So the couple learning objectives for today, one is a basic understanding of how to model like cap tables, and it's going to be very basic because most of it we're not going to cover as part of this. I really want to focus on how to issue and convert safes. Safes is a fun topic to kind of cover. It's a great example. And then we'll have a sample tool to start to use to create your own models. First off, a disclaimer, nothing here is financial or legal advice. I'm not a lawyer, not a financial advisor, not offering financial or legal advice. And I have biases in my own self from working as an investor and an LP in funds. And so I have biases from my own kind of experiences around that. There's a few things we can cover today and a few things we can't, or a lot we can't cover today. So again, we're going to focus today on safes and how to issue and kind of create them and how to calculate share prices around it. That's the most important thing. What we can't cover is, strategic questions over what tool, what is the right kind of topic to use. We're not going to cover convertible notes or equity rounds. We're not going to cover option pools or warrants or proratas or anti-dilution or recaps or valuations or exit waterfalls, all of that stuff that don't have time to cover today. I have other tools to cover those other things. So one of which is the cap table tool, which many of you have probably seen. I actually just released a brand new version of this just late last week. So if you downloaded it before, it's a brand new version that I kind of quietly uploaded last Thursday. I'm working on. That's going to reflect the stuff we're going to be covering today. The questions and recordings, yes, this is going to be a recording, and it'll be shared kind of after the presentation. My major thing is I have a structure to use to model cap tables, but there's many ways to do this. If you look online, there's tons of other cap table examples. And I think the important thing is not like the structure you use, but the line of thinking about it. And especially because so much around cap table modeling and doing scenario planning around them can be kind of custom to individual situations. I think it's important to understand the core concepts more than this is the actual structure you use. So whatever tool you may use or however you may format it or lay it out, the core concepts apply kind of regardless. So first off, what's a cap table? So for me, a cap table serves two major purposes. One is a list of actually like a list of the securities that are owned by a set of investors and how many shares they own and what type of shares they own. And the second part is an analysis tool to use to understand the impact of future financing rounds. And for me, that kind of breaks into kind of two types of cap tables. One is like a pre-financing cap table, which focuses on like a list of shares. And the second one is this idea of a pro forma cap table or post-financing. And that focuses on what it looks like after financing. So that's kind of the breakdown between the two. Now, cap table has many different like important bits of information on it, like shares and investors and those sort of things. But I want to kind of cover a couple important grounding topics. People come into the idea of cap tables with a wide variety of experience or background here. So I apologize if this is either too basic for you or too complicated for you at the beginning. I'm trying to find a good base here. But I always like to ground people in some of the basics to make sure that they understand that before we move forward. The one is the idea of like what valuation is. There's two terms we typically use around valuations. One is pre-money valuation, one is post-money valuation. And the basic difference is pre-money valuation is the valuation of the company before the financing round. Post-money valuation is the valuation after a financing round. And the way it works is pretty straightforward. It's pre-money valuation plus the amount that was invested in the round equals a post-money valuation, generally. Now, shares and share prices. Share price is the price per share that an investor is paying to purchase new shares to be issued to the investor. That's an important point. Equity investors are purchasing shares. New shares are going to be issued to the investor in most cases. The share price that we pay is the pre-money valuation of the company, basically the amount the company's worth before the funding round, divided by the number of shares prior to funding round. Now that we'll get into a little bit more on how that gets affected by things, because that's one of the most important points. Now, the number of shares that gets issued to an investor is the amount they invested divided by the price they paid. So there's a natural kind of flow here in terms of like figuring out what the share price is, figure out how much is to be invested, how many shares are being issued, increasing the total number of shares that are kind of available and issued on the cap table. So we're going to focus on two main structures today. One is the pre-money safe, one is the post-money safe. Pre-money safe is essentially treated as a warrant to purchase shares, not treated as debt. That's a convertible note or other instruments. So it's purchased as a warrant to purchase shares. And it was created by Y Combinator in 2013, intended to be different from convertible notes, to be a simpler structure that doesn't have a cap or a discount rate or interest rate or maturity. So basically a simpler structure. So I apologize. I hear my 4-year-old who's homesick today. He's crying. If he comes in and asks for something, don't worry about it. Everybody fine. I may have to hop out for a minute and we'll continue on. So I apologize upfront if that happens. There's also like a post-money safe. Now, post-money safe was introduced by Y Combinator in 2018. And the idea was that was an evolution of the safe. And the intent and goal of it was to like clarify this idea of like ownership by clarifying the exact conversion method. And we'll discuss kind of how that kind of shows up. But there's a couple of things that people do or don't like, depending on your point of view. They're introduced in the post-money safe around anti-dilution protection, or clarifying pro rata rights, for example, that can be thought of differently. So there's some differences in the structure. And there's definitely a difference in terms of how it gets calculated in terms of conversions. Now, the important thing to remember about convertibles, and particularly safes, is that they don't change issued outstanding shares, right? So when an investor purchases a safe, they're purchasing the right to purchase shares at a future point based on a future price. So there's no actual addition of shares onto the cap table at that point in time. So the actual amount of shares depends upon the next financing round. So the real kind of question that comes into like understanding the conversion of safes. Oh yeah, let me back up one more here. Sorry, one more. Here. So the most important thing to understand about when you're calculating the conversion of safes is understanding who bears the dilution. That's the most important thing. So the question comes up is from the process of when you're converting the safe, when you're issuing new shares to safe investors, who bears the dilution associated with issuing new shares? Is the dilution burden borne by all shareholders, meaning new equity shareholders investing in the round? Is it borne by existing shareholders prior to the round, or some mixture of the two? And the legal documents will specify like exactly how to calculate the share price and how to use the number of shares in calculating it. And that's the thing that's going to determine who bears the dilution. And so what happens is the most important thing to understand is how to calculate the share count, to calculate the share price per count. Every structure has a different default method for what's included in the share count, but it can vary case by case depending upon the documents. I always say that you really have to read the documents to know exactly how it's calculated. So here's like a general overview of what's generally included in how you calculate the share prices. And there's a couple of kind of differences I kind of want to go through here. One is like the first one I have is like issue new equity, right? So if you have issue new equity, what shares are included in the total of company capitalization that's used to calculate share price. So I mentioned before the price per share is pre-money valuation divided by share count, but there's a lot of different things you could potentially include the share count as part of it. So here's basically the way. The first line here talks about issue new equity. So what number of shares are included in the share count of doing it. Now the number of share counts, the number depends upon the method used in conversion, and we'll talk about the couple of the differences methods here. What the most important point I want to call out here is the difference between converting post-money safes and pre-money safes, right? So if you notice, both ones you're going to include in share count the total of fully diluted shares. Now, what differs there is the other parts. Oh, my 4-year-old, he's fine. He's watching TV. He's totally fine. He's just sick home, but he's all good. So what varies here is actually what other shares are using. Post-money safes, when you calculate the share count there, you're going to include all shares are issued from converted and post-money safes and other convertibles. Converting pre-money safes, you're actually not going to include the share count from those convertibles as part of it. But you typically will actually include new options that are issued in part of the pool. And there's a different, important kind of distinction there. So in the post-money safe, that fully diluted shares, that's going to include any existing option pools. But your calculator are not going to include any option pools that are created during the round. Pre-money safes, typically you would include that. You would include new options that are actually part of the round. And I'll get into like why that actually is the case. Now, outside of this like general structure, the important thing is to always read the legal documents, because they will specify exactly how to calculate the share count, and it can vary. Even post-money safes, there's variants that people will modify, oftentimes to remove some of the anti-dilution protection. So the actual terms can vary depending upon it. So you always have to read the actual documents in there, not just assume it's like, oh, it's a post-money safe, but to read the actual legal documents, the specific terms, and say, okay, this is exactly how to calculate it, and then use those kind of methodologies for it. And it's really the cleanest and clearest way to do that. And I have appendix slides which detail some examples of how it looks. The important thing to remember here is increasing the share count is what creates the dilution. So what happens is what we do is we calculate the number of shares that are included in the denominator and calculate the share price. And when we include more shares in the share count, what that does is it effectively reduces the valuation that the entrepreneur is getting from the company, and it reduces the share price into an equity investors paying for their shares. I use this term often called like an effective pre-money. In some past models, I've explicitly calculated, and I don't do it as much anymore. But that effective pre-money is like the value of the dilution, right? The effective pre-money is what a founder is actually getting in terms of the value of the equity of the company after accounting for the shifting effect of the dilution. Because basically, if you back to like this, this method here, if you include the value of the number of shares that are being issued to the new investors as part of calculated share count, then you're decreasing the valuation of the effective valuation of the company. And you're pushing the effect of the dilution onto the existing shareholders, like founders or any existing shareholder part of the round. If you're not including that, then the effect of the dilution is borne by all shareholders, including the new equity investors. And that's basically the difference between an investor-friendly and a founder-friendly kind of methods of conversion. And I have a little more kind of concrete details on that in a couple slides. So how do you convert a post-money safe? I do post-money safes earlier because it's a little bit cleaner. The easiest way to think about converting post-money safes is first convert the safes, then issue the equity. And that's kind of typically how you kind of structure the calculations for it. It's effectively treated as you're converting the safes, and then you convert, and then you calculate, you convert out the equity. And so by structure and by the legal documents, the dilutive impact of the safes are borne entirely by existing shareholders, not by the new equity investors in the round that come in after the post-money safes convert. Now, at a pre-money safe, there's a couple of variations of that. There's a couple of flavors. So pre-money safes can be treated there are a few different conversion methods out there that how that can be handled. Now, the difference between the methods is basically who bears the dilution. The one method I would commonly talk about is the pre-money method, or through a post-money conversion, or kind of founder-friendly option. And basically what that says is that the price per share of equity is calculated using the issued outstanding, and then we calculate the price of the convertibles. We do not include the share count of the new the shares are issued to the safe investors. We don't include that in part of calculating the share price. And what the effect is, that spreads the dilution of the convertibles across existing shareholders plus the new investors, new shareholders. Now, what that means is that the new investor buys in, and then they get effectively diluted right away. So when they think they buy a certain percent of the company, they don't actually get that after the dilutive effect of the convertibles. The other method is used is called the investor friendly. It was also kind of like the percentage ownership or pre-money conversion, for example, other kind of terms used for it. And this one, you include the number of shares issued as safes as part of the calculation of the share price for the equity. And that forces all the dilution onto the existing shareholders. Now, for practical purposes, this is by far the most common method, right? I think that the terminology that we use to describe this is kind of exclusionary and kind of confusing. And so whether it's pre-money this or pre-money conversion, I have to think about the focus of investor friendly or founder friendly. Who bears the dilution? Is it friendly for the investors and existing founders bear the dilution, or is it friendly for the founders and everybody bears the dilution? You won't see these terms in the actual legal document. That's important. You won't see it. It won't say like, hey, this is the method to be used. What you'll see is a definition of what shares are included in the calculated share price. And that's the part that matters. That's the part that infers or reflects who's actually bearing the dilution of it. The good thing about it is there's tons of documents out there to see this. So Y Combinator you go to Y Combinator documents and download all the details for post-money safes and exactly how it works. But I want to show a couple of examples first. I have these in the appendix, but not about to show a little more detail about it. There's a couple like core terms that you're going to identify like in a typical like safe document that you're trying to understand. But the most important point is on company capitalization. And company capitalization is this term that defines how to calculate the share prices, or effectively how to calculate the number of shares it's used in calculating share price. Now, here's a couple of different examples, a specific example of how it's worded. This one is like the pre-money safe, right? For example, a pre-money safe with a valuation cap. And this is taken from the old kind of Y Combinator pre-money safe. So company capitalization is all shares of capital stock, fully diluted, but excluding this instrument, meaning excluding the safe, all other safes, and any other like a convertible note. So basically what that first line is saying, hey, all fully diluted options and shares, but don't include the shares that are being issued to this safe or other safes that are being converted in this round. And then point number two basically says, do include any equity incentive or any new options that are created as a part of equity financing. Now that varies from the post-money safe, right? So post-money safe, I think those terms are different. The primary point of difference is the second line that says including all converting securities. So whereas this one says exclude converting securities, this one says includes converting securities. And in terms of the pool, do not include any increase in the option pool that's associated with the equity financing. That's like the major difference in between the two. And this will make more sense to be clear once we dig into the spreadsheets around it. Now, one caveat or side note to this is one thing that often comes up around post-money safes is the effect of anti-dilution as part of it, right? This, including all converting securities, creates an anti-dilution protection for an investor in the safe. That means that as the founder continues to raise more money via more post-money safes, all the other investors of the post-money safes, they're protected from the dilution as part of it. Some people prefer not to prefer to think of that as being not a great structure. And so oftentimes there's ways to kind of change the language around this so that issuing like the additional safes that are raised as part of this don't actually give anti-dilution protection for investors up to that point. And these are better kind of reading I'll share when I share the materials, you can click through the links and read the more details about this. But here's an example of one way to modify the language around this to capture that. So this is the same post-money safe, all the same terms except for the one I've highlighted. And what it says include all converting securities, but only include converting securities up to only up to the closing of the safe for this round, but exclude other safes that come in at other caps later on. And so what that means is, hey, you get what you own at that point in time, but as the company raises more rounds, you get or more money via safes, you get, as an investor, you get diluted kind of from them. So that's the one kind of caveat to how a different way kind of calculate it out. I think this is probably a really good time to show an example of it. So I'm just going to stop and kind of bring up a spreadsheet. And again, the spreadsheet will have, we will do, I'll share it after we're done today. I'll do a couple, I'm going to kind of show how this works in the math a little bit and then open up kind of questions because I'm sure people have some kind of questions from them, but I want to show some of the details of how the math works. So this spreadsheet has right now just 2 sheets in it. And one of them is just like straight up like a sheet from the core cap table, like that you can download for free off the site. The other one is something that I'm using kind of just to kind of show a smaller example of how the math works today. So let's start here with like the first, this example right here. And this is what I call like a pre-financing cap table. I hope this is large enough to see. I know looking at spreadsheets on screens isn't always the most fun sometimes, so I'll try to make it as big as possible and make this clear. But please, like, I'm happy to kind of come back over anything if it's helpful. So the basic example here is I just have 3 lines for 3 investors. One is a founder, or just assume like all common shareholders, for example, and they own 10 million common shares. So that's at the beginning. These are just numbers I've chosen that are not bad starting points, but they're just numbers. Don't infer anything else outside of that. And I have 2 other lines from this. One is for like a safe investor, and one is for a new equity investor. Those are the 2 things you want to understand. So the table below here basically says, for example, safe investor. So here's the pre-financing cap table, and then they raise money via safe. Well, I'm just assuming they raised a 500,000 on the safe, and I'm assuming as for the initial point, no discount rate, no valuation cap, like effectively an uncapped safe. I'll start with that and then show how those 2 terms going to change the math behind it. Then I have a new equity investor coming in. And so a new equity investor coming in here, I've just input a $1 million investment. So the total investment is like $1 million. And I have here a pre-money valuation, a post-money valuation. And I'm just assuming the pre-money valuation is 12 million. In all of my models, I use a structure where the inputs are this blue text gray background to make it really clear what's input and what's clear what's a result of a calculation. So this is a pre-money valuation, just an assumption. And then the post-money valuation is just the 12 million plus the 1 million, so post-money valuation. And kind of from this, the new equity investor is expecting that they're purchasing 7.69% of the company. And that's just, hey, how much they're investing divided by the post. Now, let's actually see how that impacts the actual cap table. So I have these kind of, what I have here is like a post-financing cap table. And what I've done is the same. I have a couple like key columns here. One is the amount that's actually invested in the round. One is a column here for, I'm assuming this is a C round, but it doesn't really matter. Preferred shares are issued to like the equity investor, and I have a separate column here for the like C1, or the preferred shares are issued to the safe investor. The important point is the safe investor, they have their existing safe, they can convert at the same different kind of price, but they're buying this basically the same kind of class of same share as the equity investor. But for technical purposes, usually they'll have like a technically different share class because there's differences. They treat them separately. They generally have the same voting rights, but they may have different liquidity preferences associated with them, and so they want to kind of keep it separately. So you typically still see like one column for the shares that a new investor is, and then like a shadow class or whatever for what the safe investor is purchasing. And I have a line for total common, line for total preferred, I'm just adding them up, and then total shares and ownership. And I'm assuming that the ownership is the same, and the total shares is issued outstanding is the same thing as fully diluted, because there's no other anything undiluted, there's no option pools, those sort of things. So I'm just assuming it's the same for the moment. So how do I calculate? So what I'm trying to figure out is, okay, well, how do I calculate how many shares they get? So for the seed, first I would try and calculate the share price. Like, what's the share price that the new equity investor is paying? Right. So I'm going to assume that they're paying, that the total fully diluted shares per rise at 10 million. And based on that, they're paying $1.20 a share. So the total C preferred shares that they're buying is that million divided by the 1.2. Right. So that gives me an idea of how much they're purchasing. And then I say, okay, well, how many shares is the safe investor purchasing? And I'm saying they're also getting the same. So for purpose, I'm just including the full 10 million as part of that to start off with. And I'm saying, okay, well, they're buying 500,000 divided by the price that they're paying. And so I have these two different structures here, calculating the share price paid by the equity investor and calculating the share price paid by the safe investor. And that kind of rolls in there. And you'll see, let me delete that for a second, that if you don't do any corrections, it's basically they're purchasing at the same price, and this is like the ownership of purchasing. Now, if this is like a post-money safe, the important point that we kind of covered before is we have to adjust for the share price that's paid. So for the share price paid by the safe investor, remember, if we're calculating a post-money safe, you're going to include the number of shares as part of it. So I can just include the number of preferred shares as part of this. And this is my total number of shares. Now you notice this is kind of like a circular thing, right? This is a circular logic that's part of it. A lot of cap table math is by nature circular. The algebra you can condense it in an algebra, but the algebra gets pretty complicated. Oftentimes, the best way to do this is to use the circular references. Whether you're using Google Sheets or Excel, use iterative calculations. You can go to Google Sheets. It's like File, Settings, Calculation. You can turn on iterative calculations. In Excel, it's Excel File, Preferences, or Excel Preferences Calculation, and use iterative calculations. And that will clear like any errors that the spreadsheet tools may say, oh, you have an error, you have a circular reference. You actually need to use circular references for a lot of the base calculations. That's okay. So same thing here. Now I'm calculating out the share price paid by the equity investor. Remember, you convert the safe first, then you issue equity. So the fully diluted share count from the equity investor is going to include the amount of shares that they're issued at post-money safe. So I include that. So in this case, they're still both paying the same price per share. And you notice what happened is the share price went down. So the share price went down from like 1.2 to 1.1, and that's because we increased the share count as part of it. We effectively diluted the pre-money valuation, or we decreased the pre-money valuation to account for the effect of the dilution. Now, this is for a post-money safe. What happens if we start assuming different terms, right? So let's maybe it's a case where there's a discount rate, right? Meaning that the discount rate says that they can purchase shares at a 20% discount to whatever the equity investor pays. So I have a little bit of a pre-built structure here, which is calculating out the different share prices. So one says, hey, what's the share price if there's no discount rate, there's no cap? And then I have two more lines here. One's for what's the share price if there's a discount rate, and what's the share price if there's a cap? Because commonly the structure, you can have a safe structure that'll say, hey, you may have a discount rate, you may have a valuation cap, or you may have both. And the effect of it, they're basically trying to say, hey, I'm trying to create a structure that enables the safe investor to buy shares at a lower rate than the equity investor pays. Basically, it's a way to compensate them for the risk that was associated with their investment from when they invested to when the equity round was raised. And these terms, discount rate and valuation cap, what they do is they provide a boundary or a structure to figure out, well, how much of a discount do they pay? And they affect things a little bit differently, right? So like, a discount rate is just literally just 20% off of like whatever they pay. But in the sense of like a valuation cap, it works a little bit differently, right? So because it doesn't have the same, it's not always a constant like 20% discount. It's gonna have a little bit of a shape in terms of the effect of the dilution onto it. And so what I'm doing here is I'm saying, okay, what's like the price per share? I'll get into like the idea of like not using circulars in a second. Yes, there's a way to calculate circulars, but some of the stuff gets a little more complicated. I'll get into that in a second. So if this calculation of share price using discount rate is basically just share price times 1 minus the discount rate. So they're effectively saying, okay, well now they're paying the 91 cents. And so their calculation of what they're actually buying more shares now because they're paying a lower price. Now, because you're issuing more shares to them, that's also included the amount of shares that's used for the equity investors. So their number changes also. So that's an important kind of point there in the sense that the equity investor kind of gets they still get, but the effect of the dilution kind of bears with them as well. And so their price per share goes down as well. Now, what happens if I include like a valuation cap for this? You know, perhaps maybe this is like an $8 million cap, for example. Right. And so now I have another share price that's used as part of this, another share price that's used in terms of valuation cap. And if you have multiple terms, the general structure is, hey, I want to pay whatever the least is, whether it's whatever's issued to the new investors or what's less based upon the discount rate or cap. If you have a case where there's no discount rate and there's just a cap, well, if the company raises money lower than the cap, then it's better just to pay whatever the equity price is. If the valuation is higher than the cap, well, then you'll pay the cap. Right? That's the cap on the valuation that you'll pay using calculating share price. So if I use this share price for it, same structure, same idea. I'm still have this thing where, you know, the number of shares being issued is the amount invested divided by the share price. And all I have here is there's not much math that kind of pre-built into it, but all this is calculating the share price in different ways. This is saying what's a share price, just the total number of shares that are available for it, divided by the valuation. And then the one below it is the discount rate, saying what does the equity investor pay times 1 minus discount rate. Using the valuation cap, this instead of using the pre-money valuation to calculate it, it's using the cap. So it's basically saying whatever the valuation cap is divided by the number of shares it's used for, and then take the least of all of them. The only difference, the little like weird thing in terms of this one is I can't just take the min of all three in the case of what there isn't a cap, because it just says, okay, I don't pay anything. So it's just a little bit differential test there, which is a little bit extra. In normal usage, you would know what your structure is, so you don't need to build it in there. But that's kind of what it's doing there. So that's kind of a base case for like a post money safe. So let's do a pre-money safe. So let's zero these out for the post money safe, for examples. Now pre-money safes can be the same thing, right? So you can still have the same kind of terminologies around discount rates and caps as part of it. So let's come back to the earlier thing we shared about how to calculate the number of shares as part of it. So there's two basic methodologies we're going to kind of cover here, and one is investor friendly and one is founder friendly, right? So if it's investor friendly, remember, you're going to include the value, include the number of shares that were issued to the safes as part of the calculation of the equity price that's being paid. So for example, this one, I'm going to include the total number of shares as part of it. And now the price per share paid by the safe investor is going to vary based upon that. Now, remember, when you're calculating the share price paid by a safe investor, the share count, the number of shares that issued to all the safe investors are actually not part of the calculation of share count. So they're still paying the 10 million irrespective. It's the equity investor that has the slightly different kind of calculation around it because they're pushing the dilution on there. If it's founder friendly, you're not going to include that, right? You're not going to include the number of shares that are included as part of it in terms of calculation of share count. So really, it's this one little difference here, which is the biggest, which has it's the difference between a founder friendly and investor friendly option there. So I'm gonna, all of the rest of the math is kind of the same kind of throughout there. I'm gonna pause this. I know I've been about a half hour of like detailed stuff and detailed math. So I want to allow some time for kind of questions and things. The question, and feel free, you can just leave questions in the chat, or if you wanted to come off mute and ask questions, I'm happy to too, whichever one you prefer. I want to get through as many potential questions as people have, so feel free. The question about to avoid the circular calcs, yes, a lot of this stuff you can do using algebra as part of it, but there's some options there where the algebra gets too complicated. But the combination effects of it get kind of complicated. And you can do it without it or not, but it's often easier to just utilize circular calculation as part of it. But in my old in all my existing cap table templates prior to the one I released last week, that is how I did it. Right? I explicitly calculate out the effective pre-money and use the effective pre-money to calculate the share price, which means you're effectively calculating out there. In the newest one I did this week, I decided not to do that. And I did it because it's easier to match the terminology. It's an easier structure here that matches the way the legal documents are written. Because the legal documents don't say like what the effective pre-money is. They say how to calculate company capitalization. So in many cases, we're actually doing this. It's easier to just use whatever the legal documents say, rather than kind of forcing us through like other hoops to calculate effective pre-money. So that's kind of why I approach it this way. However, that one works as well. Can we see how the percentage acquired works differs from what is spent? Oh yes, of course, right? So this is a case where, okay, this is actually a great example here. So this pre-money example here, investor-friendly option, full dilution that's associated with the safes is borne by existing shareholders. So this 7.69% is what they expected to own post funding, and then this is what they actually own post funding, right? The 7.69. If we zero this out, not quite the same, right? So they expected to own 7.69%, but they actually own a little bit less. And they own a little bit less because the dilution, they bore in some of the dilution from issuing the safe investors. So that's the biggest difference there. So, okay, so the difference in the valuation cap versus pre-money valuation. The valuation cap is like a term written on a safe. It says you'll be able to, you remember a safe is an agreement to purchase shares at a future price. And the valuation cap says, hey, this is the max that I'm going to agree to pay, right? If I set a valuation cap at like 8 million and you actually raise money at 12, well, me as the investor, I'm only going to pay effectively 8 million per, I'm only going to pay if it was like 8 million. But if you raise money at less than 8, like 5 million, well, then I'm going to buy 5 million share. So that sets the cap. Pre-money valuation is what the actual valuation is on the equity round. So there's a timing difference. Like the pre-money valuation is what the equity investors are agreeing as part of the new round. The valuation cap is what the safe investors agreed to on the terms of the deal. That's the basic difference in structure. More questions? It's really easy to do this really complicated. I'm trying to make this simpler to understand. I'm excluding everything I have to do like option pools because I have to exclude it to be able to kind of cover this stuff in a session like this. If there were option pools, we would include option pools as part of like calculation here. So instead of like just having these lines for like post money safes, I'm sorry, like the shares issued to safe investors, we'd have additional lines for like a new option pool, and then we add that to the calculation as part of it. This example cap table here is a more complicated structure. It's used to do like multiple rounds, and you can choose which options in terms of what type of instrument it is and all those sort of things. This specific sheet doesn't include option pools as well. The full cap table, here, that is that includes all the things on option pools. And I teach option pools as part of like the class I teach as well. But if you want to see a scenario with an option pool, that's in this. That's in that example there, which you can download. It's free. When you say YC recently changed your safe agreement, I mean that's the post money safe. Once the safe shares are issued, no, the safe investor is going to buy the same shares as the new equity investor. So they're going to, if the new equity investor is buying preferred shares, they're going to buy new preferred shares. And that's, so that, and all of this here is how to calculate the number of preferred shares. Remember, I don't want to dig too much into it, but like the basic deal is preferred shares have the option to convert into common. You don't do that until it's actually an exit scenario, until like that sort of thing's in there. So the calculation of the conversion from preferred to common is something you do at exit waterfalls. MJ, feel free to send me an email. So I'm happy to, that's a comment that long. It's probably best for me to address an email later. Feel free to email me. I do this kind of stuff with investors all the time, so I'm happy to help on this kind of stuff. Yeah, I mean, so calculate the value for each security to understand the respective dilutive effect from the pre-money. I have to, that's going to be better for me to kind of probably do offline. So just email me. The thing is, they're not, you have to remember that the one kind of point I will say is you have to remember that they don't, the terms will say how to be calculated on there, but they're all converting at the same time. And oftentimes the conversion of one impacts the conversion of the other. So, especially like post-money saves, they're written so that you include all the shares that are part of the other one as part of it. Y Combinator has a good example on this, like the link I shared, the ycombinator.com/documents in the deck, and once I distribute materials, the link's in there. But they have, you can download the actual safes, and they have like a thing called like a primer, and the primer will take you through how to actually calculate this as well. And the method they use is different. They'll calculate out the dilution percentage and the sum of the dilution percentages and use that calculate share price. The end result is the same. It's exactly the same. It's just a different way to do the math. But that's it's a good example also to read their primer to see how they talk about the math. See more post-money saves. That's a good question. Yes, particularly out of Y Combinator funded companies, and there's a lot of them. So I do see more, but it's not it's not a case where like one is better than the other. There are different vehicles used to solve for different things. Convertible notes still make sense in many cases, depending upon future expectations of the company. So it can vary. The lawyers I've talked to, who I kind of work on this stuff, there's many cases they still doing convertible notes or pre-money saves or post-money saves. It can depend. Many founders are wary of the anti-dilution protection associated with post-money saves. Some aren't. So that kind of shows up in some of the conversations. And the links in the deck I send will be really good for going into more details of it. Yeah, so I love, there's a number of other software tools to do this stuff. Carta has one, Tactic has a safe calculator. I like AngelCalc as well. There's in the cap table tool, there's links to those other tools. And on my site, I have links. Let's see, actually, I'll just pull it up. This is not a bad way to answer that question. So this is the actual page for the tool. All of these are other good tools to use. These are tools I often kind of utilize. I don't think it's spreadsheets are really great. So in general, like spreadsheets are really great for like scenario analysis. I think it works really well for that and useful to really understand the math around it. But all of these calculators are really good to do the same thing as well. And I often will use these to check to make sure that I'm doing the math correctly as well. So nothing wrong with utilizing them as well. I think once you're running a company, it's good to get out of spreadsheets. Actually managing a cap table, managing vesting schedules and options and what each kind of share class buys and tracking all that stuff around it. That gets really messy in spreadsheet and really easy to get wrong. So I usually advise, kind of like what I write here, I usually advise to use something else, use an actual spread, use a web app tool to do that. And all those are good options. But I think spreadsheets are really good to like understand it, and also quickly to understand as well. And the other thing you have to remember is most of the calculators are set up to handle generalized solutions. Oh, like post money safe, pre money safe, for example. But oftentimes legal docs are written a little differently, right? They may say include this, but don't include that. And when you get into like one-off scenarios like that, well, then it becomes a little bit harder for the tools to pre-build all the situations in for it. And so oftentimes to do, transparent auditable calculations around that, that's when spreadsheets kind of come in pretty effective for that. So, I think in general, finance in general has been, not at the forefront and seeing the same innovation in tools like other parts of running a company has. This is like a broader kind of thing. We've seen HR, IT, all other aspects, payroll. We've seen so many companies created which are intended to make it much easier in a company like that. And we haven't seen the same thing in finance up until like the last couple of years. And so I think it's great to utilize all these tools, to be honest. I'm not a spreadsheet maximalist. The question is, how often do you see ambiguity around the legal documents versus clear-cut processes for conversions? It's usually, usually when if a terminology is set up to explicitly say like how to calculate things, then it's usually pretty clear. Sometimes there is some confusion around when they'll say like, hey, something like in the pre-money or in the post-money. Then it can get a little confusing in terms of what the intention of it is or how to handle certain things. And when there's like multitude of instruments, then there can be a little bit of confusion. And usually that just becomes a subject of negotiation in terms of like how they want to. And that's another important point is that legal documents like specify how things are going to happen, but oftentimes when conversions actually happen, investors may agree to like slightly different terms than what was originally agreed to. And so, generally speaking, there's scope for kind of conversation around how to treat certain things, but it's not uncommon at all to see ambiguity. That's part of like what I've done for years is helping I come into funding rounds to analyze cap tables and try to see if the analysts or associates who are building it had done all the math correctly. So not uncommon to see confusion around it. But the good thing is that the more standardized we get with the legal documents around that, then the easier it is to understand these sort of things. I will say I've been working around startups since I first worked for a startup in 2000, and there's way less information about how to do this stuff back then than there is now. And so in general, there's a better education on the topic and a lot more available information on how to do this sort of stuff than there used to be. More questions? I have a few more minutes if anyone wants to ask anything else. Or maybe if you want to ask non-safe related things, I guess I can answer other things too. This is probably a good time to point out that I do, if this is an interesting topic, I do teach a class on this. I teach this thing called the cap table and exit waterfall masterclass. The idea of the topic of safes is like a small part of it. We cover more around, we fill in the gaps around the rest of it, which is how do you issue equity rounds? How do you issue multiple rounds of equity rounds? How do you handle convertible notes separate from pre-money safes and post-money safes? How do you handle warrants, option pools, creating issuing option pools, refreshing option pools, how does it impact share counts, how does it impact conversion of like what we've covered so far? How to calculate pro ratas for investors as part of it. I didn't cover that as part of this, but it can get a little complicated. We do get an exit waterfalls, basically saying, hey, if we have this set of equity investors, who gets what in the end of it at the result of an exit, accounting for share classes and seniority and liquidation preferences and participation rights and all those sort of things as part of it. So those are the things we kind of cover in the course. the question around the model, can model multiple safe investors? Yes. And actually in this spreadsheet, which you can download it, you can download the full model off the site, or in this sheet in here. This is actually pre-built to do like multiple investors. So you can do multiple investors at all different terms and even different types of investments. So you can mix convertible notes, pre-money saves, post-money saves, different terms, different caps, and it handles. This is a pre-built to handle all the complications from it. And honestly, the complications come from it in terms of saying, do I include this in the share count or not? You can get the effective pre-money. The way I used to do it is a little more complicated way to think about it, because you have to think about like what's the effect of the dilution in different scenarios. Whereas if you're just thinking like, hey, do I include this in the calculation of the share count matching the docs or not? And I think it's a little bit simpler way to kind of do it as well. But if you have, this is probably a good point to kind of round up on, but if you have, my general goal is the tool is available for download, it's free. If you have questions about this, email me anytime. If you want to learn the topic in more detail, class is great. If you want to, this recording of this will be available online. I'll share it out by email afterwards, and it'll be on the website. And then the materials will also be available. But the most important point is like I build the models, and I do this to try to make this stuff easier for people to understand, make it better, faster, cheaper to build models, to get to understanding and not spend less time in spreadsheets. And so my general goal is that, to try to make this easier as possible. So if you have questions, happy to help. And I work with people on this stuff all the time, so don't be afraid to ask. Yeah, any further questions, you can email me. But I really want to thank you for joining me today and being part of this. And always happy to help. Cheers.